99% right is 100% wrong. Again, it might sound crazy, but it's a mentality. I'm going to make sure everything's right.
In this episode of Investors and Operators, we're talking with Matt Salisbury, who has built, scaled, and exited two successful investment banking firms and has recently established a new firm that is solely focused on the needs of private business owners. This is going to be interesting because Matt has over 25 years of experience advising business owners, private equity groups, family offices, investors, and corporates. He has advised on over 100 M&A and strategic advisory assignments. Most of those are with private business owners. So who should listen to this episode? If you are a private business owner that is thinking about selling one day, like, you need to pause and think about some critical questions that we're going to go through, because you don't necessarily go straight into a transaction. We're going to tease all that out. This is also for investment banking firms that might have 5, 10, 15, 20 people and are trying to think about, how do they scale? What does that path look like? And how do they eventually exit, especially in today's very crowded environment? So, Matt, it is awesome to have you here. We're going to dive deep into really practical advice for private business owners. But let's kind of start off maybe around Edgeview. I mean, you started around 4 people and you built it to 60 before selling in 2007. Is that a good place for us to start, or take us from here?
That'd be great. Yeah, it was quite a journey. I'm not only excited about talking about founding and building Edgeview and Black Arch, but really want to also talk about the evolution of the M&A advisory industry, because that parallels my career. But that industry really started with a firm called Bowles, Howell O'Connor. And for me, it's evolved and ended up with my latest firm, EVP Strategic Advisors. But I think it's very important to talk about Bowles, Howell O'Connor. It was really the first truly independent, solely focused on M&A advisory boutique. It was started in the late 70s, believe it or not, by Erskine Bowles, who people probably remember ran the SBA, became Clinton's chief of staff, Charles Connor, and Tom Hollowell. But the important thing about Bowles, Howell O'Connor, they really had 2 key core values that they lived by. One was the commitment to the client, and that really meant 3 things. It meant put the client first, always think about what's best for them, think about what is the customized solution to solve their issues and meet their goals and objectives, and then there was a standard perfection in all work, which really, was a standard perfection. I had this analyst that worked for me at Edgeview that put on their wall, 99% right is 100% wrong. It sounds crazy, but that really was the standard that started at Bowles Howell. The second was hiring and developing the best people. So besides bringing several folks to kind of jumpstart the firm from New York, they started focusing on hiring people from HBS, Harvard Business School, and Darden Associates, and then focusing on their analyst class at leading universities in the Southeast, Duke, UNC, Vanderbilt. And so, they had the best people, they had high standards. The other unique thing about the time was this private equity industry now, which has thousands of firms, really was still in the early stages. There was only about 250 firms at the time. And Bowles Howell was the first company to focus on coverage of that industry. They actually built a proprietary database that covered every firm, had information on every portfolio company, and then established a coverage model where every banker had responsibility for specific private equity groups. So the firm evolved from doing corporate divestiture work and private company work to, by the time it sold to First Union in 1998, probably 70% of its deals were private equity related. So they built this proprietary database. And if you look back now, if they had kind of leveraged that, that may have been a missed opportunity if you think about the value of PitchBook and these other entities out there. But that's a different story. Rolled into First Union. It was a time where a lot of banks were rolling up some smaller firms. They rebranded for the most part to be First Union's M&A Group, and roll forward 98, 99, 2000, come to 2000, 2001, several things kind of happened. One, you had the tech bubble burst, kind of the country went in a recession, but you started coming out of the recession. in the industry, from 95 to 2001, there's about 45 independent firms that rolled up to 9 larger firms. Those larger firms were fuller service. They wanted to focus on bigger deals. M&A wasn't necessarily their core focus. So you had a market that was about to explode in terms of the number of M&A deals that had to be done, because there's been several years with the recession that there was a lot of M&A activity, yet it had a service side that had been consolidated, so there weren't going to be as many providers. And then you had a private equity group industry that had continued to evolve, which at that time, there was 700 to 800 private equity groups from 250 at the beginning of the 90s. And so,
And just for reference, how many are there now? Like 4,000 or 5,000?
I would, if you count, yes, I'd say 4,000 to 5,000 private equity, counting family offices that want to do private equity deals, counting pledge funds, counting search funds, every form or fashion. But to kind of briefly touch on kind of Edgeview, you had this unique opportunity and this gap in the market, right? You had fewer service providers because of consolidation. You had clearly the beginning was likely to be a pretty big M&A boom, and you had this private equity industry that kind of was getting a critical mass and was going to be a recurring source of business for M&A advisory firms. But on a personal front, I didn't really want to work for a large company anymore. I had this entrepreneurial, focus. And so I thought it was a great time to go start a new M&A firm. And at the same time, a colleague of mine, Drew Cortapella, who was also at Bowles, had the same idea. And then a friend named Bud Watts, who was there, put us together, said, you guys are talking about the same thing. So we laughed and started Edgeview Partners. It was a pure startup. We were young bankers. We didn't really have a reputation. But there's this great network of Bowles Hollow bankers out there that kind of knew us. And, the industry, I think, was ripe for a new firm.
How old were you when you and Drew started this?
I was early 30s.
And did you have kids, married?
Married, 2 kids, life savings in the business. Fortunately, I had a wife who actually had been an investment banker. I met her at Harvard. She was very supportive. So a little nervous.
So she knew the business model. She knew what she was getting to. All right.
Yeah, we were all a little nervous. Actually, I was never that nervous. For some reason, I just had this sense that it was just going to be successful. But we did. We put all our economic eggs in that basket. And
when you and Drew left Bowles Hollowell, like, were you VPs, MDs, or like kind of where were you?
I was an MD for a couple of years, and Drew, I think, was a VP or director. But Drew was a little older than me. He had actually been a CFO. He went to business school, had been a CFO at a company. So he kind of had also a pretty unique experience. He worked at Goldman a little bit. So he had a little bit of working at a private company as well as banking experience.
So the 2 guys were like, all right, we don't want to work in this big firm. We want to do it ourselves. There's an opportunity. Let's get a napkin. You bring the pen. Let's talk about this. I mean, how was it when you guys were starting it?
We sat around our dining room table at our house and went through to pick a name. And then we developed our business plan, again, focused on everything we did was we had to focus on not just getting a business today, but being able to easily scale it. And that's why, it's kind of we spent probably $100,000 on legal documents to think about it. If we brought partners on, how would we integrate them into the operating structure? How would we think about equity? We thought about the comp structure, even though early on that we needed to separate that eventually from ownership, because if we want to incent other senior people to come on board and we own the vast majority of the firm, they need to think they had a great opportunities they could perform and have deals. Building models, templates, so you didn't have to redo things every time. That was an important part.
Investors and Operators is the podcast of 51 Labs, a full-service digital marketing agency that focuses on private equity firms, the portfolio companies, and others in the M&A market. We handle everything from branding to video to websites, LinkedIn content, and everywhere in between. We've done over 150 projects since 2019, and usually we do a lot of work with emerging managers, so funds 1 through 3, independent sponsors, but also funded private equity firms. Reach out, happy to help out. Can we expand on this idea of comp structure?
Yeah.
and how, because a lot of M&A advisory firms are wrestling with the exact same thing. How do I find uh, how do I find and retain amazing talent so that they stay? Like, how do you build a firm for enduring growth?
So we made a choice of separating, and maybe, retrospect, we might have done it too much, but separating ownership from current comp, right? So if you think about a traditional investment bank MMA, they will have, say, they're going to take 55% of revenue, 60, maybe 60% of the high end, use that to pay comp. Then they got the overhead, and then they kind of have the profit of the firm. We said, hey, we want to have bankers come on board early. We're kind of a startup. We want to say to them, hey, if you perform, and by the way, under our philosophy, we're focused on having two partners on a deal, a lot of teamwork. If you perform, you can make more in current compensation than you would anywhere else. And over time, you'll have a chance to get equity, but you don't have to worry about the equity holders taking 30% of the profits out of the block. So our comp structure was set up that you got rewarded for identifying the deal and pitching it and working on it. And again, two partners worked on the deals together. So there's a kind of a split of credit. And so if you kind of go down the road at the end of the year, if you did 20 transactions, each transaction had a origination credit, a production credit that was shared among the partners that worked on it. And that kind of rolled up to kind of how you divided the bonus pool. So all the MDs at our firm, with their dollar production, made a lot more money than if they had been on a traditional, investment bank, William Blair, or someplace like that.
Okay. So let's go back to starting it up. I mean, like,
Mhm.
what was your first deal that you worked on? What was it like when you're really getting the business up and going?
So the other important thing we did, we said our first couple deals are going to be a reflection in the market of what we work on, who we are. So we waited. We didn't take on any small, difficult, I was going to use it crappy, but any small deals. And so we waited. And so we had an opportunity through referrals to pitch a business in California and a pitch a business in Ohio. One was a $50-60 million food company, and the other was a $200 million broadline distributor. Went into both those pitches as a new firm, hadn't closed anything, and we pitched against 3 people for the San Francisco business and 8 people for the broadline distributor. But we had a philosophy that if we went in, you could out-pitch people, out-present people, and outthink people. So our pitch presentation was honed on, one, we did a lot of due diligence up front, and we incorporated that in the presentation, saying, this is how we evaluate your business. This is how we're going to position your business. This is what you have to do to the business to maximize your value. This is the process we're going to run. We had details at every single buyer. And back then, a lot of other banks would come in with their 80% template of, here's where we are, here's what deals we've done, here's a splash page of buyers, hire us. So we convinced both those private companies to hire this new firm, never done an M&A deal as a firm. And so those were 2 fantastic businesses that we were able to then prepare and write great marketing material and go to a broad market. So the first deals people saw from us were $50 million private food company and a $200 million broadline distributor. And they saw 80-page, very detailed marketing material that was all diligenced. They saw how we represented and ran a process. When they got into due diligence, they saw that there was no surprises. And that said, gosh, these guys, do a superior, high quality job.
So I think this is incredibly important because as a startup, you didn't swing at every pitch. You focused on waiting for the right pitch to hit because you knew that would also set the pace for your branding in the market. Also, the opportunity cost of that time to what we think might be a easy deal, 1 million EBITDA, it's a super simple transaction, but it actually eats up a lot more of your time. What Where were you guys at? Like, did you have enough cash in the bank where you could be flexible to wait for the right pitch? Like, how much was on the shot clock? Was it like, all right, I really got 6 months to swing at the right one and land it?
So we definitely had a negative burn, right? We had the two of us who weren't taking a salary. We had three employees that we were paying full market rates. We had at least
You had 3 employees from like within the first month or the first 3
the
months?
first day we started, yeah, that we hired from our other from basically Bowles Hallowell, a VP,
Yeah.
associate, and an analyst. So, but we capitalized the firm with, I think at the time, at least $1 million. So we said, hey, we got staying power. We're not gonna. We really want to wait. And 9/11 hit, which made it even harder, right? You kind of start in August, you're getting going, you're launching. 9/11 hits, and nothing's going on.
Wow.
But it turned out
When did you actually get hired by those 2 companies?
in
Like, when did you
2000
sign the
in
engagement?
2002. So we went all fall and identified them, and then I actually pitched those in early 2002.
What did your wife think about this whole new business idea? You start in August, 9/11 hits, and hey, by the way, we're starting a new investment banking firm. I promise
They're a
we'll
little
make it.
nervous. The San Francisco business was our first pitch, and people probably don't remember back then how you could save money on when you fly, Saturday night to stay. So Drew and I literally left on a Friday, flew through Greensboro, went to San Francisco, spent Saturday night, his birthday that weekend, and pitched on Monday because it was so much cheaper to fly through Greensboro and stay overnight Saturday night. We stayed in Motel 6, shared a room. Never going to do that again. But then we pitched the business on Monday.
Who's 2 beds, 1 bed? Who slept on the floor? I did it with 2 beds in a Motel 6. Been there.
2 beds in a Motel 6. I gave Drew his choice since it was his birthday, which bed he get to sleep in.
So just to clarify, did you feel that pain of, I actually need to bring in revenue, but we have to wait for the right deal?
We had a conviction we had to wait for the right deal. I may have been young and naive enough. I was never actually that nervous that we wouldn't find business because of what was going on in the market. I mean, literally at the end of the day, that things were starting to ramp up. And I said, the worst case is we'll end up having a nice little M&A shop and make some good money and do 5 or 6 deals a year. We thought that was the worst case.
How many months after you started the business did you get that first check, maybe for the retainer, for the kickoff fee?
It was first quarter of 2020.
Okay.
2002, sorry, 2002. So we
Yeah.
started
So
2 months,
good
yeah.
6 months.
Yeah.
You're paying for, you guys aren't taking salary, married, kids. You got to pay for 3, experienced juniors and a mid-level. So money's leaving 6+ months till that first check hits the bank.
Yeah, but all the signs were there. I mean, we had the pitch opportunities, we had and we won, and then we had a building backlog. Then we had, Bill Morissette, Ted Gardner, who are old partners that wanted to join. They saw that we had some success. They saw there was an opportunity. I think they didn't like working for the large bank anymore.
They wanted you to de-risk it for a few months.
Yeah. The other thing when we started is we actually did have Charles Connor and Reed Leggett and a guy named Ken White, who was the guy that built big oil and gas company that Drew worked for, as our board of advisors from day one, which actually, gave 2 things. One, externally, they said, hey, Charles Connor, founder of Bowles Hallowell Connor, Reed Leggett, one of the builders of Bowles Hallowell Connor, is kind of involved with you. That gave a stamp of approval. It also, one of our first early deals was something that came through Charles in terms of an introduction. So that was I think another important part early on.
Were they equity holders on the board, or how were they just, hey, I'm happy to help you out, start the firm?
We gave each of them a percent of the firm.
Got it.
So, which ended up being worth several $1 million when we sold the business. So they were happy.
And I think that's so interesting also because like in the past month, my co-CEO and wife, Jing, we've been talking to some, people that we really respect and asking like, hey, we get no outside perspective.
Yeah.
And it's made us start to think about created an outside board of advisors. Like, we have no equity investors, and it started to make us think about the value of that. And we did a couple of meetings. And we're like, why didn't we do this 2 years earlier?
Well, I think there,
Not just the
yeah,
intros, but
this is,
like the
yeah,
true advice.
yeah, and this is interesting because there's two aspects of it. One, we did it because we wanted two things from them. One is we wanted somewhat a stamp of approval, and two, we wanted their kind of general insight and guidance. And three, if there's happened to be, because they were out of the business for the most part, the REIT kind of joined at one point for a year or two, and actually was doing deals. But there could be a referral network. The second part you got to think about is, we didn't. If you're going to have a true board of advisors, and we didn't take it to the extent, the preparation for every meeting is pretty intense. We decided that we'd give an update and have kind of brief kind of quarterly calls, but we didn't really ultimately use them as much for how do you build the business, how the nuts and bolts, and giving a 3-hour week, taking a week to prepare for these kind of advisory meetings. So they served a great purpose. They were usually helpful. Thank them to this day. But I would say if a firm's thinking about having an advisory or board, they got to really think about what they want from the board, and then tailor to that to their again, what they want to get out of the board. And
Yeah.
you're looking for a board that's going to be really intertwined in the business and kind of getting in the minutia. It's a lot of work in terms of kind of what you
Working with
prepare
them and
them,
prepare them.
educating them, and then your quarterly meetings.
Yep. So, let's talk more about that growth from, just the five of you to, selling it in 2007. So was that 5 years, 6 years?
Yep, 5 to 6 years. Yep.
So you went from 5 to 60 people in 6 years, sold it for great price, sold CIT. Uh, w- what are what are the things that you think you guys really got right during the scale up phase, not the startup
Yep.
phase?
We stayed a pure M&A advisory firm, focused on primarily covering financial sponsors. So we had a coverage effort, and then opportunistically through referrals doing private company work. And so roll forward to 2000 and late 2006, we started getting calls from different folks interested in us. Merrill Lynch was the first one to call us that was looking for an M&A platform. At the end of the day, we had offers from Merrill Lynch, Lazard wanted to build a lower middle market practice, Cowen, which is a public company, CIT, and a couple others. CIT was the most interested, most motivated. They wanted to bring us in not only for an M&A platform, but to use our financial coverage to help sell their debt products. And so,
Can you give us a snapshot? Where was the business at? Like, from when you started the first 12 months to where you ended, like, what was the average transaction size, do you think?
when we sold the firm in 2007, we had about 60 employees. Where we did 45 to 50 million of revenue, and that was composed of probably 40 to 45 transactions. And so our average size deal at the end of it was 100 to 150 million dollars.
Okay. Your average transaction size is 100.
Yeah.
What do you think are some of the main roadblocks, as well as just mistakes, that you made during the startup phase and the scale up phase?
I think in retrospect, the biggest mistake I think was not thinking bigger, because we talked about, hey, do we want to have a private equity capital? Do we want to do this service? If you think about Blackstone's, and not that we ever would have been a Blackstone, but Blackstone started as a little advisory service, and then they added things on over time. So I think we missed an opportunity, and we talked about it to have a investment side of the business that would have been used.
Well, that's such a interesting point, because like, we're at a similar stage where, we last year we placed 5 junior consultants in a recruiting role at a consulting firm. This year we placed another 5, repeat clients. Now they're referring. And then we're at this stage where one of our advisors like, don't focus on other things, just focus on what you're best at right now. And if you look at the full scope of marketing service, he's like, wait till you have a critical mass. So did you guys have a critical mass in your M&A services where you had the bandwidth to truly think strategically like that? Or, in retrospect, like, we actually just did the right thing by just focusing on what we're best at. So would you have,
I think that
was it a rational?
drove ultimately the interest at the end of the day and the value we created. But we did, 2005, 2006, we had the critical mass. We would have definitely taken some resources away from the M&A advisory, but I think I could have hired people there. But and again, maybe it's just, second guessing looking back. Obviously, anyone that was doing private equity starting in 2025, you had to be really bad not to make a lot of money. You had the whole, growth in the industry, expansion of multiples. But saying that, it all worked out great. But I think that's the only thing. I think if thinking as an entrepreneur, thinking bigger, would have been one thing I would have done differently looking back.
I love it. Anything else on the Edgeview story around the exit or things? What advice do you have for other firms that might be in a similar position are getting approached? They're at a critical mass of 25 or 50 people and they're thinking about it. Like, what advice do you have for those M&A firms that are thinking about exiting?
Yeah. And so, when we get to Black Arch, that's a little different scenario, but the, Edgeview, we weren't thinking about selling until we had multiple people approach us. And then we said, we gotta, we should we need to think about this, at least hear what people have to say. And then we actually took our own advice and we hired someone to help manage that process. Even though we were M&A bankers, we said, we need someone to help manage that process and figure out if there is the right opportunity and if this interest is as big as we thought. And it was just a perfect timing. If you think about 2007, there wasn't, people were looking for what we had. We had built a great platform. Harris Williams had a successful deal with PNC. So the stars aligned and we had a lot of interest at at frankly values and structures that were too good to turn away. And so,
and you exited before the Great Recession really took off.
We agreed to our deal in June. It was locked in, and we closed in late July. And between June and July is when everything hit the fan. So if we had not locked in our deal in June, I'm not sure a deal would have got done. If you think you roll forward, we went from 45 to 50 million revenue the last year of us to they did 5 million of revenue the first year under CIT's ownership. And CIT ultimately had to file bankruptcy because of the financial crisis.
Wow.
So timing.
So you were feeling it, like you were signed in June, July, like, okay, this is happening. Like, this is what's happening in the market. Recession is happening. And then July,
the deal had to close. There was no outs in the deal, and they didn't try to get out. It was early enough before they really saw how bad things would get. But the other thing is, they wanted to rebrand us, which as CIT, which when we get to Black Arch, we've learned that lesson. But what that also gave us is, because they wanted to rebrand us, we said, well, there's not going to be an earn-out. You got to pay us, up front. We're not going to take the risk that you change our brand and can't execute, and don't allow us to execute the strategy. So we're also fortunate to have kind of all the economics kind of up front. And obviously there's some retention related stuff, but there's no kind of earn out. Which again I think was relatively unique.
Whew. All right. Talk about timing.
Yeah.
It's interesting because you started the business a week before 9/11, and then you exited the business right when the Great Recession was happening.
Yeah.
07, 08. What were you doing from when you truly exited, like 08, 09, before really starting Black Arch in 2010? Just kind of where was your head at? Of like, were you just chomping at the bit, like, okay, I got to do something?
Yeah. So I actually, and part again, this will get into Black Arch. So I was I didn't want to sit around. So I actually had worked with Kelly Cataragan, who had been a partner at Bowles Hollow and actually had done a lot of strategic advisory for Edgeview. And we kept looking at kind of strategies to work with private business owners. We looked at like a portal to bring in, all the different services, HR, buying, and we're trying to figure out how to address that market. So we're trying to figure out some other thing, to do within the advisory industry. But I clearly wasn't, ready to hang it up. So all of a sudden, again, you're coming to this time period, you're coming out of this recession. There'd been a contraction in the number of M&A bankers. You had these private equity groups that had these portfolio companies that they had to start selling, right? Because they had to return capital to their investors to raise more funds. And so you had, again, I call it a gap in the market to start another firm. And Black Arch was a little different because we were able to start a firm with instant credibility, and we were kind of running out of the block. So Black Arch was started with 4 principals, all that brought something unique to the table. So Drew and I had started Edgeview, ramped it up, built it. We knew how to do that. We had great reputations in the market. Kelly Cataragan, third partner, had been a partner at Bowles Hollow. She had helped us a lot with strategy at Edgeview, and then she had been working directly with private companies for probably a decade, helping them with strategy. So she had this thought about how we could have a more proactive outreach to the private company universe. It was very fragmented, and start mining that. And then Bram Hall, who had been Harris Williams, had built a very successful industry group in the transportation and logistics. So he had kind of expertise in building industry expertise. So we hit the road with 15 employees, basically 6 senior bankers, and, fully capitalized it. And to some extent, the market thought, Edgeview was back. And we immediately got engagements from private equity groups like Cortec and Valfurious and other groups. So I think out of our first 10 deals, probably 6 or 7 were private equity. And we were, cash flow positive within, 6 months. So that was a different startup, right? We added 2 kind of new elements to the firm. We continued with the, put the client first, perfection's the standard, hire great employees, develop them. But we also added a direct to private company marketing effort that had, white papers, had content for them, had solutions for them, had an outreach to generate more business in the private equity world, which was one thing. 1 was a great business line. 2 was business that I particularly enjoyed. And 3, having that deal flow made you even more important to private equity groups. And then the 4th thing is we started really building truly industry expertise. Because again, the industry is evolving. Or now industry expertise, particularly for the private equity clients, became more and more important.
General timeline is you started it in mid 2000. You started Black Arch in mid 2010 with 15 people from day one.
4 original partners, 2 other senior folks, and we started in mid 2010 with 15 folks out the door.
And then you sold the business to Regions Bank 5 years later in 2015.
Correct.
And you had 40 people, and then at that time you're doing more than how many deals you had done you completed 200 transactions with the team in 5 years, but like what were you at in
so when we sold to Regions, we had, I think, 45 employees, had been doing 30 to 35 deals annually. I think our revenue was probably $30-35 million. And that situation, interesting, that Regions had approached us. They wanted an M&A platform, and we kind of talked to them for over a period of time, and then came to the conclusion they would be a good partner as long as we could structure the deal to create kind of a long-term sustainable firm. So with them, we basically said we need to stay an independent, relatively independent operating company. So we kept our brand. We contractually kept the ability to kind of run and build our business. We had a separate contractual compensation program that we could say, and it was higher percent of revenue than the industry, and said, okay, we can continue to build this firm, attract people as a pure M&A platform. Sort of like the same thing Harris Williams did with PNC, a decade before that. And that deal was actually structured where it was a third up front and then a third an earn out based on annual performance and a third earnout based on a cumulative kind of revenue, which we killed every metrics. And, it's worked out great for both parties, and it's been a great addition to Regions. And today, Black Arch probably has 15 MDs. They're, wouldn't be shocked if they're doing 80 to 100 million in revenue, 40, 50 deals. And so it's, it's successful for Regions, and it was successful for Black Arch, and it's successful for platform for the people still working there, which is exciting.
What how was junior and mid-level retention at Edgeview and Black Arch, and how did you guys keep the team versus other firms?
So Edgeview was interesting. It was a race to hire enough people as we were growing. We had never had an issue with retention. We had the pick if the undergrads didn't want to go to New York, they wanted to come to us or Harris Williams. There's a few firms. And part of it, we had a great training program, and we had a great 2-year program, and we committed to place the analysts mainly in private equity groups. So we would work hard, at the middle to end of their program to make sure if they wanted to go into private equity, we would find a home for them. And the private equity groups wanted to hire folks from our firms because the way we train them, the deal, the private.
Yeah, it's a pipeline. It's a farm league. It's kind of mentality of like,
So,
they're already ready to go.
Yes. So that ended up being retention was never an issue. And we had, 20, 50 resumes for every position. So we had great people, and then, and it creates a loyal kind of alumni base that, even stays with me today. People work with me, are happy to hear from me, and who will, and have helped out in many different ways. On the associate side was harder because everyone was hiring. Everyone at that time was ramping up and hiring associates. So we recruited directly out of school, but we hired a lot of lateral associates, and there was definitely more of a turnover in the associate level because there was such a demand for the full-time banker, and that was a harder retention, and also more turnover because sometimes you hired people that maybe didn't get to the standard you wanted, so you kind of had to move on. And that was reflection just in terms of the growth of the market and the demand that other banks had for the talent. Black Arch, Black Arch, the market was growing, but it had stabilized. So we were able to, I think almost all our hires were directly out of schools, and we were able to have a pretty high retention rate of kind of bankers at the associate and above level. And a lot of it's interesting when you look at the MDs today, there's probably 3 or 4 that started as either analysts or associates, and just to kind of work their way up to be partners at the firm.
That's interesting. Did you start both firms with a clear idea that you were going to exit it?
Neither firm. I think if you start a firm, think you're going to sell it, you'll never build a good firm. So neither firm did I expect to or thought we'd sell. And Edgeview, again, perfect timing, perfect storm, had a lot of people approaching. It was sort of like, almost be silly not to do it at the time with what was going on and the offers we had. And then Black Arch, again, evolved with a great firm, but I think the different views on where to take the firm in terms of diversifying other options probably was what resulted in us, seriously considering doing a transaction with Regions and trying to find the right home for the firm to continue to prosper as a pure M&A firm, which again,
so it
worked out great.
The right team for that stage of the journey from startup to scale up, and then just people had different desires and what to do next.
Yeah. Yes.
Well, before we go to this chapter with EVP Strategic Advisors, some of the questions I have are around what advice do you have for the analyst or the associate?
Mm-hmm.
And then what advice do you have for the VPs and above who might be in their 30s, married, maybe the first or second kid, and kind of painting the picture for them. But let's start off with the advice that you have for the analysts and the associates.
Yeah. First of all, this is general advice for anyone that goes to M&A is you have to go in M&A knowing that it is a lot of work, a lot of hours, and to some extent kind of thrive off that. It's as you move up in your career, you can get more balance, but to be successful, you really need to think about you're going to outwork people and you're going to, get there first and leave last. So my advice to the young people is, you know, think about getting there, leaving last. Think about, again, there's two analysts just stick out in my mind. The analyst that put up on his cube 99% right is 100% wrong. Again, it might sound crazy, but it's a mentality. I'm going to make sure everything's right. So working hard, working towards perfection, asking questions is key as a young person. You need to, if you sit down and someone goes through something, asks you to do something, you should ask many questions to make sure you kind of understand and don't just, some people have the tendency, like someone might think I'm stupid or don't know what I'm doing if I don't ask questions. Ask questions. And then the other story that I love is, it gets to, another thing I think as a junior person you do is, there was a time frame in our industry, I think I remember the balance of life became important and you started doing protected weekends. Firms started saying, hey, these analysts are working 7 days a week. We need to put in some lifestyle balance because it's not sustainable. So we're going to put these protected weekends in where from Friday at 8 to Sunday at noon, you leave and no one's going to work. And the partners had to manage towards that. And the first week we put it in, we get a call from Bain on a pretty significant, Bain Capital on a pretty significant deal. And it's Friday. And we're talking about it among a group and Drew's the lead. And we're like, oh, God, Drew, you're going to be the first person that's going to have to ask an analyst to work on the first weekend. They were going to have a protected weekend. And I remember we had this analyst walked in and sat down, and he was a kid that graduated from Williams College, and he had done Teach for America. He came and he said, hey, I want to work on this. I didn't come into this firm in investment banking to take the weekends off, but I want to work on this deal. So what that says is, if you're proactive, like there's a lot of people that will have their deals, they'll get free capacity, and they'll be like, okay, I'll just wait for someone to come to me. I think you also need to be proactive to say, hey, I'm available to work on something else. And then also that allows you to kind of somewhat identify sometimes things that you want to work on and people you want to work on. So work ethic, a standard perfection, and proactiveness in terms of, seeking work, particularly with the partners that you want to work with. I think all be usually successful for your career as an analyst or an associate.
Now, what about the early 30-year-olds who are married, might or might not have a kid, or maybe want to get married, but they haven't seen the life outside of the office for who knows how many years? Like this mid-career of like, should I keep on doing this? Like, do I want the life of the MD? Like, what advice do you have for the mid-career banker?
But as a mid-level person, I think you have to think about, for long-term stuff, where can I make my mark on revenue generation and new business? Because you don't want to stay in this industry and just be the execution guy, right? Then you're never going to be able to get a balance of life. You might be a great execution person. Everyone wants to kind of have in your deal, but you're going to be in the trenches the whole time. So I think the folks that are most successful and make the most money and kind of eventually get a balance, they find an area that they think they can generate revenue, whether that is more and more kind of some sort of industry expertise or relationships they're building with specific private equity groups. But that's kind of, I think, the differentiator for those VP directors is who can be a business generator versus who stays just a good executor. A good executor is never going to have never probably going to have a chance to have a great work-life balance.
You've been in the M&A industry for over 25 years, and you have started, scaled, and exited 2 successful M&A advisory firms. So there's clearly the data point and the and of seeing where the puck is going. Where are we at now in January of 2026 in terms of the M&A advisory industry? And what do you think will be happening in the next 3 to 5 years? Maybe taking into account your thoughts around the economic context.
I'm somewhat shocked when you look out there. There's thousands of M&A advisors and brokers and hundreds and hundreds and hundreds of firms. It's crazy. I mean, versus the Edgeview days when you could probably put them on half a page. Anyone who was out there that had any kind of credibility. I mean, there's hundreds and hundreds, and they're all transaction oriented, right? They want to get a transaction. They want to get paid for a transaction. Secondly, there are now dozens of firms that have the quality of execution that a private equity would say, yeah, they'll do just as good a job as someone else. Hey, so you used to be able to differentiate yourself on being just superior quality of preparation execution, and now there's dozens of people that I think sophisticated private equity would say, hey, I'd hire William Blair Lazard, Harris Williams, Blackarch, Houlihan Lokey, and 10 or 15 other boutiques that say they're going to do a great job selling my business. So why am I going to award them the business? So it's going to be, hey, what deal volume do I see from them? How do they treat me in a sale process? Do they have, there's some industry verticals where the industry expertise is still really important. Do they have some kind of deep expertise in some buyer? But I think a lot of the private groups are now handing out business based on who's giving them the most volume, who's showing the most deals, who's showing the most ideas. Again, how have they been able to buy business from them, which sets up a whole different dynamic, I think, if you're kind of a private business owner. So the exit opportunity, there has been a continued number of exits, but I think they're going to get fewer and fewer. You've had some smaller specialty firms exiting to some of these smaller commercial banks that want some M&A capability. I think the firms that have some industry expertise have been kind of rolled up, but I think it's going to be very hard. I mean, who's going to buy if there's hundreds of these firms out there now, and the major financial services already have their M&A platform? I think that the day of building an M&A focused boutique and thinking you're going to sell it, or it's not likely.
Well, I wonder if there's going to be, and this kind of leads into the EVP story of, is there an opportunity to create small industry focused M&A advisory firms who exclusively do not work for private equity at all? They don't touch it because they don't. So it's like a first principles question.
Mm-hmm.
Like, I'm either going to build this and going to work for private equity and play that game, or I'm going to take a whole different route and I will be the best boutique M&A advisor for HVAC. And my whole job is that I know everything about the industry and everyone knows me in the industry, and I do not work for private equity. I wonder if there's going to be that, and to what extent that has already happened in certain verticals.
So two things. If I was going to build a sell side M&A focused company again today, I would do it. I think the most successful way to do it is finding a couple deep vertical industry verticals. But I wouldn't say I wouldn't work for a private equity group if I was doing that, because there's literally 30,000 portfolio companies that need to be sold that owned by private equity groups. So if you're the HVAC, plumbing, and so forth expert, if you want to say small and kind of be a broker and be just doing those, $500,000, $1.5 million deals, that's one thing. But I'd call those people more brokers that are kind of finding the companies, putting them up for sale. The 20 platforms out there are going to look at them and they're just kind of getting the deal done. But if you're going to be a true high quality M&A advisor, you're going to want to work on bigger companies. And ultimately, as a sell side advisor, transaction oriented, you're going to want to try to get some deal flow from private equity groups, because there's literally thousands of them now, and that's where the most of the companies are. So that's if I was going to do transaction-oriented sell-side M&A.
So let's shift gears over to the EVP story. Like, you've been doing this for, you started 2 firms, scaled them, sold them, and now you're doing EVP Strategic Advisors. Like, what is EVP? Why did you start it?
So EVP Strategic Advisors is kind of the last iteration and where I want to spend the rest of my career. It has one purpose, and that is to focus on family and privately held entrepreneurial businesses and help them figure out what is the best thing for them and how can they maximize their outcome. I think we talked about this before. You now have an industry with thousands of M&A advisors and brokers, all focused on one thing, a transaction fee and selling the business. And you have thousands of firms and professionals, whether financial sponsors, family offices, individual investors that want to invest in or buy a private company, focused on getting the best deal for themselves. There's no one out there focused solely on advocating for the private business owner and figuring out what is in their best interest and then being on their side of the table. With my background, I know exactly all the games the buyers play. I know what sophisticated investors do to try to extract the most value, and I want to bring that to bear on the side of the table of the private business owner. So what does all that mean? It gets back to all through my career. If a private business owner says, I want to sell the business, I always start with, why do you want to sell the business? And that gets into the first part of anything we do with someone is, let's really figure out who the stakeholders are, what everyone's goals and objectives are, and can we get everyone on the same page? And when you think of goals and objectives, everyone wants to maximize value. I mean, that's common across every private company for the most part. But what does that mean? It doesn't necessarily mean just selling the company for the highest value. So maximization of value really is a priority for most business owners. And that will get into how you do that in a little bit. But when you look at the other goals and objectives, you have to talk about, what is their lifestyle? How much money they need to meet their personal spending and goals in the future. And that is going to be done by taking money out of the business or potentially selling it. You also have to look at, what is the estate planning then? What is their goals that they want to have in estate planning? Do they want to keep all the money and spend it? Do they want to give money to their family? Do they have charitable aspirations, right? Or they want to give it all away to charity? They want to give some away to charity. All that goes into figuring out how much they need to generate from this business, either growing it or ultimately selling it to meet those needs. And all those leads into strategies that should be done now, estate planning, charitable tactics that can better position the business to realize that. Then you have a second group of questions on, what do they want to do with the business? I mean, do they like running it? Do they want to run it? Do they have other people in the business? Or are they ready just to move on? And if they are, then you get talking about who's going to run the business. Is there someone ready to step up? Then you have a discussion about their management team and employees. What's their goals with them? Are they financially incented? Do they have equity in the business? How do you want to treat them if they decide to go down a process? How do you retain them? How do you incent them? Then you have a whole nother questions about, if you go down a transaction, how you deal with confidentiality, how you deal with, again, your employees, how you deal with communication. So that's kind of phase one. That leads into phase two. We say every client, we start with a strategic advisory assignment, which is really to assess the business. What are the value drivers? Where are the deficiencies? Where are the issues that need to be focused on? What growth plan can be put together, both organic and potential acquisitions? Ultimately, growth is what drives the most value in almost any situation, whether you're growing it on your own or whether someone's looking at buying it. So having a well-documented plan of how the company will or could grow is important. And then documenting that into a long-term plan. That then leads to, you've done the work on goals, objectives, you looked at the plan, the options, can you grow it organically, do you do acquisitions? That leads into discussion, okay, well, what's the best course of action? And business owners have a lot of courses of action. A lot of people just retain the business and grow it and take money out of it. You might want to do an ad acquisition and continue growing business, or do an added acquisition to position to sell. You might take money out through a debt recap or a minority investment, which leads to a whole nother set of governance issues and other things to think through. Or you might decide it's time to sell the business to a strategic buyer or a financial buyer. And again, those two groups have very different things you want to think about and be concerned about that might go back to your goals and objectives. So you figure out the course of action. If the course of action is to ultimately sell the business, then you want to not only maximize the top line price, but more importantly, you really want to maximize what you take home and all the terms that go around a transaction, what happens to your employees, how you communicate to the market. And that leads to a long list of not only getting the highest price, which is really going to come back to the work that was done to prepare the company and have a plan that people can understand the growth opportunity. It's going to come back. It's going to come back in terms of maximizing your after-tax proceeds and the use of those proceeds to planning you've done beforehand in terms of estate planning, charitable planning, structuring the business. But then you get into a lot of nuances of a positioning a sale process. One is you want to sell the right earnings of the business. And that's not just taking your earnings, adding back owner's comp, adding back one-time expenses, but it's really looking at how you can position the earnings of the business in the best light. I.e., if you've won a new contract, if you have a new customer, you can annualize that and show higher earnings. If you've invested a lot of money in new salespeople or for certain growth that's depressed the earnings today, you're going to want to add that back and say, those are investments for future growth. Don't penalize me on my earnings today. And there's a series of those things to do on the right earnings. The other thing is to make sure those earnings and financials stand up to scrutiny and due diligence, because there's, in a process, a surprise, a negative surprise or a positive surprise, it's not a good thing. A negative surprise, if someone comes in and there's something wrong with your accounting and earnings, or there's an environmental issue that you should know about, or you've kind of missed your near-term forecast, is going to destroy a lot of credibility, and it's going to result in a much lower value for the business and people's concerns of whether they can buy into your longer-term vision. Flip side, a positive surprise that you should have known about, whether, hey, there was, real estate value, whether, hey, we were just about to get this new customer, you've missed an opportunity to capture that in a process to maximize value. So kind of sell the right earnings, make sure you're prepared that there's not going to minimize the chance that there's either negative surprises or even positive surprises that you could leverage in the process are important. If you're going down and you're willing to talk to strategic buyers, you got two aspects. One is, how do you deal with them from a confidentiality? What do you give them when? How do you manage who can look at the business? A whole bunch of things about protecting your business. And the flip side, if you're going to sell to them, you're going to want to look at maximizing your value. So you're going to want to proactively quantify all the potential synergies, because if they're going to realize revenue or cost synergies in your business and you decide that that's a course of action that you're willing to go down, then you should make sure you try to get paid for that, which leads into thinking about, the treatment of your employees and management. And that's a whole nother kind of area of thought you have to do in a planning of a process, because you're going to need your management team on board to a process, incented to have the right outcome, but also feeling like they're protected in the long term. So that gets into thinking about employment agreements, whether they're sale bonuses, how you structure those. Do you structure them so they get paid afterwards, so they stay at the company, and a whole series of things there. There's confidentiality issues and how you communicate to employees when or customers. And then from a transaction structuring, there's an incredible amount of value that can be created on a lot of little things. Like if you're an S Corp, how you structure the deal. If you're a C Corp, an LLC, they're structuring things that can have, millions and millions of dollars impact. How you set your post-closing adjustments, let alone if you're looking at things like an earn out. when you should use it, how you should use it, or rollover equity. But that whole list of things, every one of those is an opportunity to maximize your outcome. And if you don't have someone that's really focused on each one of those specific areas, you're going to end up with suboptimal outcome. And we think about the two constituents we talked about at the beginning: sell side M&A advisors and brokers that just want a transaction fee. And the fact that many of the high quality folks get most of their deal flow from private equity groups or strategic. They work with strategic companies. They're really not incentive at the end of the day to fight for every last dollar and every one of these terms at the end of the day. And then obviously, if you're thinking about private equity people approaching you, wanting to buy your company, your incentives aren't aligned at the end of the day. They're going to want to get the best price. They're not going to identify real estate, other values. They're not going to say, "Oh yeah, your earnings aren't 5 million, they're 7 million because you could have done these add backs." And they're going to not be sitting in your shoes to kind of structure your rollover equity incentives to fit you and your management team. So that's why we exist. We exist to work with the private business owner, the families, the entrepreneurs, being an advocate for them, sitting with them on their side of the table and making sure they get the very best outcome that aligns with what ultimately the stakeholders want to achieve.
I love it. And there's probably 100 more questions for each one of
There
those
is.
different routes.
I love it.
But that's why you got to work with the right people.
And I love what I do. I love working with these people. I love working with the right entrepreneur. It's the most satisfying thing in my career, honestly.
If you had to summarize some of the key regrets that private business owners have post-transaction because of poor advice or no advice, what would those be?
Well, I think it falls into a couple of camps. One is sometimes who they end up selling to, right? At the end of the day, if you do a financial sponsor, so if you back up. So if you're going down a strategic road, you have the whole issue about if you're trying to deal or sell to a competitor and how you do that, right? So someone may have a regret that they went down and the banker and the focus was, hey, the highest price at the end of the day was a strategic, but they bought the business and they gutted your business and so forth. And gosh, if I really had thought about it, or someone really spent a lot of time with me, that might not have been the outcome I wanted. And by the way, in this day and age, you probably could have got a very similar price with another avenue. The private equity route, there's so many flavors and forms of private equity groups out there. There's good partners, there's bad partners, there's partners that will come into companies that need operating help. There's partners that will only buy companies that have full management teams. And so the current M&A advisors that get a lot of their business from private equity groups are not incented to sit down with an owner and say, don't do a deal with this group. They're a bunch, you run into a bump, you're all going to get fired. They're going to be a terrible partner. These two guys are great. Hey, you're looking to transition out of the business. These are the 4 groups we talked to because they have operating partners who will help you achieve that. So I think we've got sometimes people they ended up selling the company to the private equity group with the highest value that ended up being a bad partner. And I think the third category is, a lot of successful entrepreneurs think they kind of know how to do everything. They've been approached by folks. And then they go sell the company and in retrospect realize that, oh my gosh. And this is probably one of the bigger ones. It's like, there's a lot of value I missed. If I just taken the time to prepare correctly, if someone had pointed out to me that I could have stripped this real estate, these assets out, I could have kept those as cash flow. If someone had better advocate for me in terms of how I structured the business, in terms of whether they buy assets or stock, or talk to me about how I could have given upside to my management. I think there's regret afterwards of what they could have done once they learned more, or where they could have maximized value. So I think it's two sectors. One, did I end up with the right buyer? Did I have someone helping me kind of understand the pros and cons of the buyers and give me true advice of who to deal with? And two, I missed opportunities to fulfill other goals, to get the best value and potentially fulfill other desires I've had in terms of legacy, charity, estate.
Yeah. When you look in the past 25 years, why do you do what you do? Not where you're at now with EVP, but your whole career. Like, why have you stayed in this industry?
So I started my career in New York and initially was in a loan workout group and then in capital markets. And the loan workout group, you had to analyze businesses and you kind of get in the deep. I loved it. And I went to capital markets and it was just not for me. And it was swaps. It's like FX. And so then when I moved to Charlotte and had the opportunity to work for Bowles Hollow, I just found an environment that I loved. I was a little sick because I thrived on the work, the hours, but what I love most is really understanding the businesses, getting in the details and figuring out how to grow them and also maximize their value. And so I enjoyed it from day one and I thrive it still today. I mean, I worked 60 hours last week. Well, not last week, the week before that. Because I just love what I do. I still get the models. I still do the research. I still dig in and I just passionately enjoy it. And over time, the biggest part of my enjoyment has been working with these very successful entrepreneurs who know their business inside and out and winning them over that they can trust me and I can help them be successful in areas that they don't necessarily have their expertise. And that's why I'm doing it now. And I don't need to actually do it for the money. I'm doing it because I really have a passion for it. And I also think there's an opportunity with like-minded people that were in my industry that are maybe later in the careers to do the same thing, where at the end of the day, they said, hey, I've done great in M&A. I've done great in this, but I kind of like to spend the last part of my career, not only in helping these private business owners have great outcomes, and you'll get rewarded for it, but not running after the private equity deal, the next private equity deal, the next transaction, have to get 8 deals done in 1 year. We start from zero the next year, and it's all about the transaction fee.
Yeah.
That.
What was your first job?
So it's interesting. My first jobs in high school were probably like everyone else, needed to make money. So I was a paper route. I was a bus boy. I mowed lawns. And then summers I worked in a maintenance department of a manufacturing company. College was really, I think, when I first focused on kind of entrepreneurism. I actually owned 2 businesses in college. I owned the business that was the birthday cake delivery business. So I would have mailings to all the parents like a month or 2 before their kid's birthday and say, hey, if you order cake for 8 of their friends, ice cream would deliver that. And then I owned the used bookstore. So we basically, at that point in time, we get the curriculum. Everyone would give us their books with little slips of paper in, and we would sell the books for 50% of the face value, and we give 50% to the students, and we keep 50%. And so that ended up being 2 great businesses. And actually, probably the reason I got into Harvard directly out of a business school out of undergrad was because I had those experiences. But those always lived with me. And I went into investment banking, and then the first year we were married, my wife had worked at Goldman. She had gone to Harvard. She was at JP Morgan. We almost bought a bandana business in northern New Jersey. We came very close to buying. They had the brand for Harley Davidson. It was just bandanas. They had a great little business, and we at that point we continued to look for small business, and we made an offer, but life could have been very different. We could have been living in a little town in northern New Jersey, running a bandana business and building a bandana empire. Things worked out differently.
How many kids do you have?
2 kids. My daughter is a doctor up in Chapel Hill, married to her college sweetheart, and my son graduated from Chapel Hill and actually works with me at EVP Strategic Advisors. He started his career kind of in film production and writing after UNC, and then transitioned into banking, working at a small healthcare boutique. And then when I started EVP Strategic Advisors, I was able to convince him to come work with me, which has been great.
How long have you been married? We can edit the right answer.
2 years, I believe. You're still my most important partner in life, business as well as personal. So
How have you managed marriage, being a quality father, and also starting, scaling, and exiting, you know, two investment banking firms, and living a very demanding life? How have you balanced that? I got 4 kids, so I'm trying to figure it out.
first thing, I was lucky to be married to the right person. So yeah, we've talked about this over the years where, so she knew the industry, but she kind of bought into it. She made a choice. She actually came to Charlotte, went to private equity, and then when our second child said, I'm going to stay home and raise the kids. But the difference, she was very supportive. So I would travel, not be home a lot, and the kids would be, hey, where's dad? And she would say, hey, dad's in a hotel. He misses you just as much as you miss him. So she was very supportive of it with the family, which I think is very important, because I know more than a few people who spouse, it could be male or female, is at home saying, oh yeah, dad's or mom's away, it's terrible. And so one is having that support was key. Two, we decided didn't want to be in New York. So outside of New York in the industry, you could have a much more chance of kind of have more for balanced life. But what that entailed is it was work and it was family. I didn't play golf. I didn't do any other thing. So when I would come home when I wasn't traveling, even if I have to go back to work, I'd have breakfast. I'd drop the kids off school. I'd go to all their events. And the weekends, when I wasn't working, it was dedicated to the family. So I had really no other activity. So that they were a priority. Work and family was a priority, and having a supportive partner in the endeavor, I think, was key at the end of the day.
Any particular formative moments throughout, your upbringing that really kind of guided what you've become?
My great grandfather founded a company called and ran a company called Syracuse China. He donated it to Syracuse University, almost all the equity, because he thought that giving back to the community was the right thing to do. My grandfather went into a company called Pass and Seymour, was a shareholder, worked his way up to run the company for 20 or 30 years. He turned down raises every year and said, I have enough money, let's give it to the employees. And then didn't search out for more and more equity. So he retired and then was on the board, and they brought this outside guy, and all he wanted was higher pay, more equity. And he came to the board one day and said, hey, I want you to guarantee to buy my equity at this price. And my grandfather said, I tell you what, if that was the company's worth, then all the shareholders would get it. Unfortunately, the guy went out and found a French buyer for it. But my grandfather maybe got $2 million out of it, and this guy got 15 or 20. And my grandfather ran the business for 20 or 30 years. But I think what I got out of it, work ethic, fairness, teamwork, giving back to employees in the community, was fundamental. My dad could have gone to New York. He decided to come back to Syracuse, support the community. He was a commercial banker or trust banker, made a good living, but he was at all our games. He was supportive, and but I think I look back at that family history, and it was always do the right thing. It was always give back. It was not look for the last dollar. Take care of other people. And I think even setting up the firms I've set up, it's been pay people fairly. I probably could have been more selfish and if I wanted to, and try to keep more ownership, and but I think at the end of the day, it's worked out well for everyone involved.
There we go. All right. Well, we have covered a lot.
Yes.
All right. Well, thanks so much for doing this.
Right.
It's been great having you on.
Thank you very much. Appreciate it.
See ya.
Take care.